Linda's one of my favorite women. Every conversation that I have with her is absolutely amazing. She's such a treat, and she knows so much. She spoke yesterday, and we know that she was the first, New Zealand woman CEO listed on NASDAQ, the youngest woman as well, until last year. Oh no. She's a global serial entrepreneur. She's on the board of, several organizations and airline as well. Yes.
UNICEF, and I'm the global board.
Yes.
And New Zealand, and then I'm on ASX. I chair ASX listed companies.
Wonderful. Yeah. So welcome her. She's amazing. And then we have Mitch Mechigian, who is a partner at Blockchain Co-Investors, and he co-manages the direct co-investment platform that focuses on blockchain, Web3, and fintech. Welcome.
Hello, everyone. And maybe
I like the way things change in these panels. We're getting
we have Lou Kerner as well joining us. Welcome, Lou. So he is the founding partner of Crypto Oracle, and he is also a partner at the Blockchain Co-Investors. Welcome.
And so maybe just because you heard from Matthew today about Link2, we wanted to talk about Blockchain Co-Investors just very briefly. Lou is a partner there, and so am I. So I have a few just slides just to run through very, very quickly. Like I said, I'm Mitch Mechigian. I'm a partner at Blockchain Co-Investors. I'm also CFO of our SPAC. Lou's the CEO of the SPAC, and Matthew's the chairman. And that's highly relevant for today's conversation. At Blockchain Co-Investors, there's three main things we do. The first of which is we operate a family of fund of funds. These are the top performing fund of funds according to Preqin and PitchBook, in their category. Through these funds, we're investors in more than 40 blockchain and crypto specific venture capital firms. Through those funds, we're actually indirect investors in more than 400 projects and startups. So really seed and early focused in that fund. We then use that fund to source deals for two other vehicles, which are our early stage token fund, which invests directly into projects pre-mainnet launch. So before you can buy them on Coinbase, Robinhood or Binance. And then if they go mainnet launch, obviously they go liquid. And then we also have a mid-stage growth fund, which we've just launched. And this focuses on those mid-stage rounds, so Series B, C, and D. And again, we're using that asymmetric information and connectivity in the space to source those deals as well. Just a few more slides. Again, this lays out exactly what I've said, but just gives you a bit of structure on what we do. We have three fund of funds, an early stage token fund, which those tend to be a bit smaller because those early investments, check sizes are only 250,000, 500,000, really seed investments most of the time. We have our mid-stage growth fund, as I noted, which just launched, which will be our largest fund. And then, for today's purposes, again, in our discussion on secondaries and what Linda's done, we do operate the largest and most well-capitalized blockchain-specific SPAC. Again, the idea there is that we partner with a private blockchain company and help facilitate, their listing in the public markets. Last slide again, just very briefly here, just to give you a little bit more detail on the individual funds. We have three open funds right now, and again, you can see our first fund of funds, in the fund of fund category is performing exceptionally well, and our other funds are on track as well. So thanks for that just brief introduction. You heard from Matthew, and you'll hear from Lou and me as well now.
Sit down in the middle. You want to start off giving us a bit of your background?
Sure. Well, I gave a little bit of background yesterday, but as it relates to this topic, I've done an IPO, I listed on the NASDAQ. I've also done a RTO, which is where you merge a company into a public shell on the Australian Stock Exchange. And I chair a number of everything from $10 million to $6 billion valuation on different public exchanges. So I have quite a bit of perspective in terms of, timing, lessons learned, the romance of it. In my first listing, the investment bankers and the accountants made more money out of it than I did. So, there's a whole set of sort of lessons for the wise in terms of the romance of public markets that really interested in exploring today. So have sort of been playing with this going public, being private, what's the best place for growth companies for more than 25 years.
And so currently a partner at Blockchain Coinvestor on the Mid-Stage Growth Fund. And again, more relevant for today, I'm also CFO of BCSA, was our NASDAQ traded SPAC. And really in that process, aside from the filings and the regulatory, arrangements we need to comply with as a public company, I'm really leading the M&A process as we look to partner with one of those private blockchain companies. Previously, I was an investment banker in a previous life, as I say, at Morgan Stanley, both in New York and London, helping companies go public in the equity capital markets group in New York, and then working in the M&A team in London.
You're not going to tell them about your thesis?
Lou loves my thesis. Lou is obsessed with my thesis and always brings it up. So in between, I was a graduate student at London School of Economics. That's how I got into, I was always a personal investor in cryptocurrency, but professionally actually came by way of academia. I was writing my dissertation on cryptocurrencies and the nation state capacity, divergences in regulation, particularly looking at the US and China and Europe.
Yeah, cool. And my background's relevant for the discussion today. I was a Wall Street analyst, and then the second company I ran was called Bolt. It was the largest social media company, social network in the world before MySpace blew by. We peaked at about 23 million kids. I did 9 acquisitions during my time there, companies that were generally started by 16, 18, 20-year-old kids. I was the first person to call up Zuckerberg and offered to buy Facebook about a month after he launched. And fast forward, 4 years later, I was offered the opportunity to buy secondary shares. I was just angel investing in Facebook. And it was actively traded at $16 billion. And I thought to myself for a moment, I said, I think I'm really maybe the smartest person on the planet to actually know what this company is worth. I was a Wall Street analyst. I had run a social network. I took about 5 minutes and was shocked to find that I thought it was worth $50 billion. And I'd never seen anything that mispriced at that scale before. So I felt compelled to write a Wall Street, buy as much as I could. And I wrote a Wall Street style research report, valuing the company at $50 billion. And I ended up going viral a little bit. And a friend of mine ran a small investment bank on the West Coast called Wedbush. And she hired me as Wall Street's first private company analyst. And we monetized it by opening up the first private shares desk on Wall Street. And that was 2010. About 60% of our business was Facebook. There was a lot of demand for Facebook shares. And but it was a struggle at the time to get other shares because the VCs had a stranglehold on the shares, and they didn't like the shares getting outside of their control. And so I ended up leaving to be a venture firm, to be a VC. But now, there was a great TED Talk by Bill Gross from Idea Lab, where he said that did a study of the more than 200 companies he started and found out the key factor of success isn't the idea, and it isn't the management, it's timing, right? And so, this business that I started in 2010, I think now it's really the timing is here, I think for multiple reasons, including the number of unicorns has scaled dramatically. The value of those unicorns has scaled dramatically, and the stranglehold the VCs have had is lessening for lots of good reasons. So anyway, starting with that, and thinking about secondaries now and the markets for secondaries, where do you think we are in terms of the growth of that industry?
Yeah, I think it's growing substantially. I think, all the things we've heard from Link to, point to the added value from being able to enter companies, in that mid stage and late stage before they take that leap to the public markets or M&A. Because you really have to think about it in reverse, right? If you're investing into a company, how are you going to get that exit if we haven't yet reached, buy, hold, sell, is you need that liquidity event. And, for those larger multi-billion-dollar companies, there really is M&A process, which is not going to be available once you're of a certain size, or it will, be used much more seldom. Or there's those public listings, so direct listing, IPO, SPAC in the US or other countries have the various forms. And so, as we have this, and Susan, who is supposed to be on this panel, who's not here, she has a great presentation where she shows now this buildup in unicorns, and they have something like 400. Blockchain co-investors we track, we have something like 70 blockchain-specific unicorns. And so you have this buildup of high-quality companies that are kind of on the precipice of those major liquidity events. And so, the market downturn might push this out a few years because it's going to be less attractive to enter the public markets. But with this buildup, those opportunities for secondaries are going to start to look very, very attractive, particularly if some of those valuations compress, and that trickles in from the public markets.
Interesting. So now you've obviously been around for a few cycles. Obviously we're hitting a rough patch now, but as you look at the markets, do you care what the markets are? Do you wait for better timing?
Well, it's interesting. Timing is everything, but I would argue that 25 years ago I listed, but even today in the companies, I've got companies that shouldn't be public. In terms of, because a lot of the reason why you go public isn't necessarily that you're at a sustainable level or you're at a point where your industry is mature, so that the amount of information you have to expose about your competitive position is a real disadvantage to you. And if you look at the majority of the IPOs that have gone out in the last year, they're underwater. And what happens is that you start going backwards and it's a credibility game. So, two of the companies I chair, we should be taking private from that perspective. And I think a real driver for it is liquidity. So this whole concept about what that secondary market looks like is key. And, I saw in Silicon Valley when it first evolved, when, Facebook and Twitter and all these companies didn't go public, the sort of the second generation of these companies. But, there weren't enough angel investors and there were, with the smaller positions, but also there weren't enough of those companies. Well, what I see holding back the angel investment side is the ability to exit. It's also, there's so many family home offices and other places that you can get capital, sort of same issue. I wouldn't go public until I absolutely had to. One of my companies, we used it as a ability to acquire companies. We used paper to acquire 75 companies, but that was great when your stock price was moving forward. As soon as, we were literally, 3 days away from going from $500 million in value to $1 billion, and there was a cyclical downturn and we lost our ability to buy anything. So the argument was, actually, we shouldn't have gone public. We were too early, we needed to be a lot more innovative. So I think this is a significant opportunity. I think, one other thing that's changed for entrepreneurs is it used to be that you didn't get any money out until that liquidation event, which is why the IPO was so important. But today that's changed and it's incredibly important to enable that along the way. So I think this is, the concept of an IPO. It's actually, you often end up, being illiquid. You often end up at a significant competitive disadvantage, and you often end up losing momentum where you can't use creativity to continue to recreate and recollect. So the whole concept of, so not to break everyone's bubble, but it's not so much fun, And I wish someone had told me that there is no panacea.
So one thing I was thinking just when you were saying that, and I wasn't around during the original .com boom, but I'm curious what you two think, seeing kind of this cycle and maybe the crypto is analogous to that and blockchain's analogous. And one difference I see is that right now we only have something like 20 pure play publicly traded blockchain companies, and there were 9 listings last year. But in the .com boom, obviously had a massive spike in go public events, most notably pets.com and things like this. Do you think that maybe the more availability of secondaries and more liquid private markets, a la Link2 is actually shifting the public market access?
Well, sure. I think if you can get all the capital you need in being private, that you can hold off longer than. But the main reason though that you want to go public then after that is for the liquidity premium, right? The more liquid your shares are, the higher it's valued, and that's being public. And so ultimately, you really do have a fiduciary responsibility at some point to your shareholders to go public and maximize the value of their shares.
Wow.
And you
the analyst perspective.
And so you, for these companies that you say you want to take private, you think that because...
Hold on, that sounded kind of derisive.
I triggered you, sorry, Lou.
And so you've mentioned that you have 2 companies that you're on the board of that you want to take private, and then so you don't, you're not seeing the benefit that Lou's pointing to in that share premium because the liquidity is too small. So is it then a question of size?
I think, well, it's a multitude of things, and these are particular instances. So at different times, there's different windows. So at one point, if you wanted to take your startup, it was the London Stock Exchange was focusing on small companies, right? Australia is a place that you can list, and New Zealand, but more so Australia, you can list as your startup round, as your angel round, you can list onto the public exchange. The challenge though is that you've then got the, whatever it is, the 7 to 10 years till you're an overnight success. And you've been telling people like Lou, who, more analytically inclined, about what you're going to do, where the reality is, it takes you 7 or 8 years until actually what you say is what actually happens. So they've completely lost confidence in you, even though you might be hitting the 80, 100, $150 million mark. And therefore you don't have the liquidity. And it's sort of like you've burned every individual, major SME fund. Well, they don't really tell you that when you start, right? And so, and then you're vulnerable to get picked off. There's all these different dynamics going when, as an entrepreneur, you're still trying to, you're trying to build the thing, right? And so the complexity of the investor management is just exceeds, it's just too much, right? So I've got, one situation like that, but, swings and roundabouts.
Yeah, as we've seen, I originally got involved with blockchain co-investors. The first thing, I was an advisor when they launched because I was a guy in crypto and a friend of theirs and was happy to be an advisor. And then they were getting a lot of deal flow from the VCs who were getting in deals, and they could get more. And if it was more than $1 million, then it made sense to do an SPV. Less than $1 million, it didn't make financial sense to set up an SPV with all the costs. But AngelList is a great platform, and I knew how to leverage AngelList. So we now have more than 900 LPs on our AngelList syndicate, and our first investment just got acquired, Wire. And so, that's an interesting deal. As you look at that now and you see the companies, right? The secondaries, it's not just about IPO though, but it's about getting acquired. And, as you're looking at these things, Mitch, how do you think about the liquidity? You think it's more for the IPOs or the acquisitions?
Yeah,
or the tokenizations?
Yeah, I think tokenization is a route that's very interesting that kind of brings the liquidity up earlier in the cycle, right? If you think about these tokens that everyone buying and trading, it's really you're buying venture investments. And so a lot of people don't realize that, but it's as if you could have bought Facebook shares in 2003 or 2004. The volatility would have been crazy as the company went through the ups and downs. And that's what we're seeing with tokenization. So that's a very interesting route. But for companies and projects that choose not to tokenize, whether for regulatory reasons or institutional reasons, or because the centralized structure just makes more sense for them. Again, you're left with that IPO or the M&A, in the ultimate, and really depending on the sector and what the public markets are saying about the analogous companies, I think is going to dictate whether you choose to go M&A or public route. And one of the impacts of this downturn is that I think you're going to see a lot of companies on the cheap now that still want that liquidity event. And so you'll start to see that consolidation in the sector as more and more companies see that they can grow inorganically now with potentially cheaper valuations. And for companies that are already public, you can then trade your liquid security, as consideration, and that becomes attractive to targets.
Interesting. One of the things we're thinking about in the public markets in Australia, are they starting to see much on the crypto side?
They're very conservative, so not yet.
Not yet. You were saying they're conservative in terms of the crypto comes in conservative? The
That's
exchange.
right, just in terms of crypto. But interestingly enough, the first Bitcoin EFT just launched just this month in Australia. So, as I chair a couple of the major superannuation funds, and they're highly regulated. But it's sort of the challenge for the looking for the return and the differentiation. If you don't achieve a certain return, you get you basically get put on the bad list. And all of your investors, the Australian government, demand that they send a letter saying that you're not performing and you should leave. So there's a real, thirst to make sure that you're not in that situation.
That's good incentive.
It is very good incentive. Yeah.
And so Lou, one question for you. So, again, bringing this back to secondaries, now with the kind of public markets and a little bit of a downturn or a crypto blizzard, what have you, how do you think about remaining vigilant on valuations? Should you go into a secondary offering? Have you reset in your mind what's an attractive, maybe Series C, D, or late stage company? Or do you think that the long-term trend, as we've heard, maybe is up and to the right, and so as long as you're still getting access to top quality companies in the long run, it doesn't really matter?
Yeah, I mean, I think one of the interesting things that's going on is you're seeing the very top firms, the Insights and the Tigers, have dramatically scaled the number of companies that they're investing in, because I think they went back and they ran the numbers and they realized they were investing in 1% of what they saw, and they realized if the next 5% would have returned the same amount of money, and so that they wouldn't hurt their returns and they would just be managing more money. So you're starting to see this large growth in the scale of what people are investing in. Now I forgot the question.
Yeah, so do you think that is reset, at least temporarily in the next year or two, how you're thinking about maybe those secondary style valuations? Sure. Do we need to rethink now with the public markets down, or
with the valuations?
Is it still consistent in long term?
Yeah, I think it's hard. There's such the winners in this market. The way that I actually I pitched the fund of funds is that there were $5 trillion winners in Web 2, and there are going to be 10 or more multi-trillion-dollar winners in Web 3, and we're going to own them all. And that's really what Matthew and Allison were solving for when they started the company, and that's why they're grown to a breadth now of more than 40 of the leading VCs, because they're seeing new VCs that are doing things that VCs weren't doing. There didn't used to be a metaverse, and VCs investing in that. And so I think that's the right strategy, right? For me, going back, you talked about the internet. I was there at the internet, right? So if I went back and it was 94 and I knew what the internet was going to be, right? And I knew for the next 30 years it was going to go like this, but I didn't know what the Googles or Facebooks were going to be. What would I do? I'd do this.
Well, it's interesting because I was one of the last companies to get VC funded at the .com crash.
Yeah.
And we got underwater. Our valuation. We went from suddenly having to spend $5 million in 6 months. Otherwise, you weren't doing it fast enough to protecting cash. But it was interesting because Jack Dorsey, we hired him when he was 17 to work for our company, and we were at a garden party, and that's when he said, "Oh, we're going to start a texting service for teenagers," which became Twitter. And it was sort of like everyone thought everything was over because it was the dot-com burst. Everyone had lost their jobs. You had to shut down companies. But the reality was that, and the company I started was all about, they thought that the shop face was going to die in 2000, right? Well, it's sort of, in terms of what's happened. And so, and the other big difference between the dot-com crash and now is the amount of money that's been put into the system. It's going to take 5 or 10 years for that to wash out. And so I don't really see this as a very long correction because there's so much money out there, but also just the level of innovation. It's sort of, if you compare where we were in 2000 to now in terms of, to your point, the opportunities, everyone who's in my circles just believes that this is actually great because everything's just got more reasonable, and actually this is the time to buy. This isn't really a correction. In terms of from a historical perspective.
Sure, I agree with you.
I've seen before.
Yeah, I'm a very active blogger. I've written more than 350 crypto blog posts, and I blog because I don't know what I think. Many people, I read what I've written about it. And the third most read post I've ever written was December of 2017. I wrote a post because I get asked, is this a bubble? Is this a bubble? Is this a bubble? And and I wrote a post that said the crypto bubble isn't a bubble, it's a ... And it was very short. It was literally 3 graphs. The first graph was a graph of Amazon's share price from 98 to 2000, up 65x. And it says, is that a bubble? And then the next one was adding 2 years, which was, so you saw the up 65x, down 95%. Is that a bubble and a crash? And then you telescoped out another 20 years, and that massive bubble, and what looked at a massive bubble, the crash at the time, was literally with time, was an imperceptible blip. And there's a great law called Amari's Law. He was a professor at Stanford in the 70s when he coined it. And it's the fact that the impact of all major new technology, like crypto, the impact is always overestimated in the short run and underestimated in the long run.
Mm-hmm. So, voila.
Thank you. Wait. A couple of questions. Any burning questions?
Yes.
No.
It's not a concern. It's not a concern.
I'll take another one.
Can you hear me okay? Okay. My question is specifically, well, for Linda, I guess, but Linda, how would you rate the 4 M's in the Mosaic score? The momentum, market, money, management, from, what's most important to least important?
So management, momentum, what was money's last, and what was the one before?
Should be market.
Market.
Well, momentum, market, money, management.
Right. So to me, it's management first, momentum, market, money.
Great question.
Do you want to know why?
Why? Yeah.
Well, because, and it's just such an old adage, having been in Silicon Valley for 30 years, is that it's the entrepreneur's ability to create it and make it happen. And it doesn't matter if you're in the biggest TAM, if you've got the most money, if you've got momentum, if you can't create it, it's not going to come together, right? Money's easy. Money's everywhere. Everyone goes, oh, I've raised money. To me, that's a signal that you're focusing on the wrong things. Because if you're focusing on the right things, money's a piece of cake, right? Momentum is so critical. So to me, the billion-dollar mindset, the vision, and making sure that you're in a big TAM is part of that. But then it's your ability to reverse engineer what that looks like, and what are you going to do in the next 90 days? That's all that matters. So all these people who go away and dream about things, to me, it's like, okay, what am I going to do now? I'm going to create it now. I'm going to watch it and observe it. And so that creates the momentum. And then, you're creating a market because you're looking at it in a way that people haven't seen it before. And then money, it's, like I didn't pay for a gin and tonic till I was 30. That's just, and, that's only because I had to, But you know what I'm saying? So to me, that's how I think about it.
Thank you. One more question? All right. Well, it looks like lunch is holding you up. Or lunch will be. No, but Linda, thank you guys. Thank you very much, ladies and gentlemen. But I want Linda to spend just a minute, talk about the impact that you're having on the environment, the world, with your UNICEF program. I know you've got some great news to share today.
All right. So I don't know, a couple of different things that I'm doing. I don't believe that you make money and then you help people, because I actually think that's fundamentally destructive. I really believe in doing things that make a difference in an integrated way. But a few other things that I'm working on is, so I don't know if you know, UNICEF is the largest UN agency, a $9 billion organization, and it initiates 50% of the vaccinations for children in the world. And it was the only organization in the world that had a fully integrated vaccination infrastructure. So COVAX, which is the world's program for vaccinating everyone for COVID, UNICEF is running. And so I chair UNICEF New Zealand, and today our foreign minister put another multi-millions into the program, which made New Zealand the highest contributor in the world per head for COVAX and helping the world. So
congratulations, well done. Thank you so much.
Thank you.
Thank you.